We've spent past videos talking about how the stock market is difficult to predict, almost impossible to forecast. In today's video, we are going to be talking about what happens when markets trade at extreme prices, whether that's extreme expensive or extremely cheap. What we see is clearer patterns start to emerge. We're going to take a look at a chart, we're going to look at these patterns, and then what it can mean for long-term investors and how they can think about their portfolio. Okay, let's jump into the chart. So this chart here looks pretty complicated, but don't worry, I'm going to explain what all these dots mean. So over on the left, if you go from top to bottom, you have negative returns all the way up to positive returns. This is your 10-year real return. So that is after inflation. What is the rate of return that you have gotten on your investments for 10 years annualized? So 10-year return after inflation. And then this bottom line, this 0 all the way to 45, this is called your starting CAPE, or your cyclically adjusted price to earnings ratio. We've discussed this in past videos. That is a fancy way of saying how much are you paying for the earnings of these companies. Okay, so again, on the left side, we've got your rate of return going from negative to positive, and then this horizontal line, 0 to 45, that's talking about the price that you pay. And then we've got all these dots. At the top left, we've got some dots, and then it kind of trends down, and then on the bottom right, you can see some clear dots. Well, before we talk about extreme prices, let's talk about pricing in the middle. So what this chart is essentially doing is it's saying based on the price that you pay, what do the next 10 years look like in the market, essentially for the price that you paid for your earnings. And really in the middle, what you can kind of see is if this is your 0 line, where below it means you lost money for 10 years and above it means you made money for 10 years, what you can see here is most lines or most dots are above the 0 line, but there's some dots that are below the 0 line, but there's not really a pattern. It kind of looks like a circle. There's not really anything forming here, right? So if you were to buy something at a 10 times price to earnings ratio, okay, here, versus a 20, yes, there's some more negative observations in the 20, but you can win in either scenario, right? So in either of those prices, you could have a positive rate of return for the next 10 years. So let's talk about extreme pricing. So rather than looking at the middle, let's look on the edges. So first, let's look at extremely inexpensive or cheap. So let's move over to the left. What happens if you're able to buy, and this is for US equities, what happens if you're able to buy US equities incredibly cheap? And so this is around 5 to 7, 5 to 8 price to earnings ratio, which is very cheap. Well, what you see here is if we just draw a little line, that essentially there are no negative 10-year returns once you start buying equities cheap enough. And so what does that mean? If you get a good enough deal, it's really hard to mess it up because you're buying things so inexpensively. Okay? So if you buy it cheap enough, there are no negative observations. Again, these are not predictions about the future. There are no facts about the future. That's why they call it the future. This is just showing what has happened over multiple observations, and it makes sense. If you buy something cheap enough, it becomes difficult to mess it up. Well, let's go over to the other side. Let's look at these dots over here, is once you get past about 35, right, and you start getting into kind of those mid-30s, all of your observations, all of your 10-year real returns, so those are your returns after inflation, are below 0. Now, does that mean it's impossible for them to be above 0? No, it doesn't mean it's impossible moving forward. It just means throughout history, if you pay too much and the price becomes too high, eventually it has been difficult to return positive outcome or positive returns based on the price that you pay. That's just what history tells us, and it makes sense on both sides of the extremes. And so we look at those dots and we say, well, Kyle, this makes sense, right? If we buy things extremely cheap, it's difficult to mess it up. And if we buy things extremely expensive, it becomes difficult to make it work because earnings have to outrun price. So many things have to go right, and it's difficult to do that over long periods of time. So then we look at it and say, okay, as long-term investors, we should probably want to know, if, as we're allocating our funds, and this is to US equities, where are we today? What are our chances based on the past? Well, let's look and see where we are today. Today's cyclically adjusted price to earnings ratio, again, that fancy word for saying how much are we paying for investments, is this dotted line right here. And as you can see, it's just above 35. Now, you might be looking and you kind of look and see, okay, based on the current price, as we've just discussed, how many times have we been able to pay this much for an investment in US equities and return positive returns, acceptable outcomes? And as you can see, again, we don't know what happens in the future, but in the past, at this price, things have not looked good. There's a big gaping hole where there could be positive returns because there are none. We haven't had positive experiences paying this much for an investment. And so again, in the middle, right? If you're paying kind of average pricing, you can have up periods, you can have down periods, anything can happen, right? But when you buy things incredibly cheap or you buy things incredibly expensive, price becomes such an important component that it becomes difficult for the market to outrun it in one way or another, right? Whether it makes it difficult to mess up or makes it difficult to succeed. And right now, based on the price of U.S. equities, right? Not all U.S. equities, right? Think about S&P 500, more expensive stocks. There are cheaper sections of the market. However, on the whole, right, this does not bode well for looking into the future and expecting what we saw recently, as we've discussed in many videos. And so it's important, as I always say, to know what you own and know why you own it. Get with your advisor. Talk about a chart like this and say, what's the plan here? How are we expecting to achieve the rate of return that we've discussed if it's never happened in the past based on its current price? It's not to say that it's impossible, but if the odds aren't in your favor, you say, where can we be allocating our capital to where the odds are in your favor? And you have a higher chance of achieving your goals. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.